It's French. Mort, gage. Dead hand. Yeah, that's right. So when you take out a mortgage, you're allowing the lender to put a dead hand or lien on your property, generally a house. Either way, when you borrow money, you have to pay it back. So traditionally, the moment you receive money, the clock starts. Interest begins accruing. Let's say, for example, you borrow $100,000 at 4%, which means over the course of a year, 4% is $4,000. So you will have accrued $4,000 in interest, or $10 a day. So the moment the clock starts, the next day you owe $10 in interest. At the end of a 30-day period, that's $300. So you make your first payment, let's say it's $500. The first $300 goes to pay the interest, and then $200 to drop the principal by $200 to $99,800. So your balance starts at $100, goes up and then down. Next payment up and then down, up and then down, etc., etc., until you amortize it over the life of the loan to zero. And that's how a forward mortgage works. A reverse mortgage is different. Since there's no payment, I loan you $100,000. At the end of the year, you owe me $104,000. After 2 years, $108,000. 10 years later, you owe me $150,000. Now, going in, we're going to make sure that you have some equity, and it's generally about half. So in our $100,000 example, the value of the property was about $200,000. And that's going to move a little bit higher, a little bit lower, predicated on your age. We also know one other thing is that if your house is worth $200,000 today in California, 10 years from now, it's likely to be higher. We just know that history tells us that. Not necessarily in a straight line, but it does go up. So that's the fundamentals of a reverse mortgage. When you die, or you move out, or you sell the property, time's up. We need to settle up. And that's when you pay off. So it's kind of like a zero coupon bond. I'd like to pause for a moment and give you a testimonial. This is Brenda, one of my favorites. I've known Brenda for decades. She used to work for Easterbrook and Daniels as a secretary. There's a really real estate firm down by the pier in Oceanside years ago. They've long since disbanded, and she's retired 15 years now. And she bought a little condo on Myers just a block up from the pier. Nice lifestyle. Calls bingo on Tuesday, gets her hair done on Wednesday, walks to farmer's market on Thursday. In every holiday season, gets on a plane and goes to Boulder, Colorado to see her daughter and grandkids. Great lifestyle. But as the years rolled on, things began to get a little tight. First thing she did was, she couldn't quite afford the trip to Colorado. Then she gave up the membership at the club. Then she stopped getting her hair done every week, once a month now. And the car kind of needs fixing, can't quite afford it. So she got to the point where she had to make a decision. Brenda, you either sell and take your proceeds and move to Hemet or Lancaster, or you do a reverse mortgage. So she tracks me down and we have the conversation to decide we're going to do a reverse mortgage. Now she owes $120,000 and the property at the time was worth $4,000. So we're going to give her $2,000. She only needed $120,000 to pay off the mortgage, and that left $80,000, which we just made a line of credit. We're not going to touch it. We're just going to put that in the pantry for later, for emergencies. Now, she wakes up at 3 in the morning, ready to worry, and then realizes, oh, that's right, I don't have that payment. Go back to sleep. Rejoin First Class Fitness. Gets her hair done every Wednesday. Upgraded the Buick, and best of all, see the daughter and grandkids during the holidays with gifts. Now, we're not talking about an extravagant lifestyle. We're just talking about independence, quality of life. Trust me when I tell you this, as a senior myself, be 70 in a few years, it's not always just, return on investment, but it's return on time. The quality of my time. Where am I spending it and how am I spending it? So that's one testimonial of many, copious good ones. Let's shift for a minute and talk about qualifying in the process. You need to have a home with equity. You need to be 62 years old. Oddly enough, the same age you need to begin collecting Social Security. We'll come back to Social Security in a minute. You also have to have a little bit of income. That's kind of new in the past year and a half. You have to be able to pay property taxes and the insurance and homeowners dues if there are some utilities and a little food, bare minimums. If those are met, then we sit and we design the right reverse mortgage for you, because you can receive the money in 3 different ways, or any combination. A, we can just write you a check for the proceeds. B, we can make a line of credit, which you can then take what you need when you need it. Or number 3, it can be what we call a tenure or monthly payments for as long as you live in the property. Once you move out, die, go to a rest home, or sell, time's up. So it works like a 0 coupon bond. Once you've decided that you want a reverse mortgage and I give you a proposal, your next step is to get independent HUD-approved counseling. And I'll give you a list. It costs a few $100. So you talk to somebody completely different, and they're going to echo what I say, but they might say it in a different way that maybe you'll understand. So it's a really rich and wholesome part of the process. They're also going to check that you're lucid and you're capable, that you're with it and can handle these decisions. So it's another safety valve. But once you've had that counseling, then you come back to me and we begin a traditional loan process. Take the application, open escrow, pull title, order an appraisal, underwrite, draw docs, and close. It takes about 30 days. Now, there's all kinds of reasons to get a reverse mortgage, but it's almost always lifestyle. And I will tell you, as a senior myself, I've given this thousands of hours of thought. And if you haven't, you should begin thinking about retirement. When you reach age 62, coming back to Social Security, and if you look on the Social Security website, you can find out how much you're projected to earn. Let's say it's $1,200 every month. Well, if you wait a year, it goes up a little bit. And for every year you wait, it goes up a little bit more till you reach 70. It's almost twice as much. So there's incentive to waiting. And sometimes you can't wait because you need it. You need the cash. So a reverse mortgage is an excellent way for allowing Social Security to cook. And oftentimes it's that 4th leg in your retirement stool that gives you just the stability that you need. Because you know you're going to have Social Security. You've been saving like the dickens to put a little bit of cash in the bank. You've been working like a dog to fill up your 401k or some kind of a pension. And sometimes it just isn't enough. So it's that 4th leg, the reverse mortgage, that just might give you the stability that you need. And believe me when I tell you, this is a big deal. I mean, I'm just one of a herd of baby boomers that are plowing into retirement at the rate of 6,000 a day. These conversations are rampant. And if you know somebody that's a senior that needs to have this conversation or begin the conversation, have them call me. Now, we've talked about the word mortgage, kind of a funny word, a testimonial, maybe some of the reasons, the process, and I have a handout here for you that echoes the things I've spoke about today. I want to thank you guys for being my friend, and I want to thank you for listening. And please have the confidence that you have somebody call me that I'm going to give them the kid glove treatment. Thanks for watching.